Pay very close attention, because if you're treating every single one of your loans the same way and just sending the minimum payment to each account every month, you're effectively setting your cash on fire without realizing it. I'm not being dramatic. I've seen countless individuals sabotage 20, 30, even 40 years of potential wealth accumulation simply because no one ever explained the basic mechanics of how borrowed money actually works. Here's the core idea. Debt isn't one big uniform category. Some types of debt quietly drain your net worth month after month, compounding against you in the background. Other types of debt, when used correctly, can function like a tool that helps you build assets and increase cash flow. And I'm willing to bet that most people reading this are prioritizing the wrong balances first. I've been repeating this message for years in interviews on business television and in boardrooms. Today, I'm going to walk you through 3 specific categories of borrowed money that you should stop attacking aggressively right now, and I'll show you exactly what to do with those dollars instead. This single shift in strategy is the same approach that helps preserve and grow multi-generational wealth. Let me share a bit about where I'm coming from. I wasn't born into money. I started with nothing, built companies from the ground up, sold technology businesses, invested in hundreds of early stage ventures, and today manage capital that produces meaningful passive income every year. Early in my career, I made nearly every financial error you can think of. Each mistake became a lesson, and the biggest lesson of all was learning the real price of money. Most people look at debt as one giant pile: mortgage, auto loan, credit cards, student loans. They toss them all together mentally and then throw extra cash at whatever feels most stressful or whatever they were told to eliminate first by family members. That method is a slow, quiet form of financial self-sabotage. I'm going to be direct with you today, and some of you won't like what you hear. Some of you will think, wait, that's the opposite of what I was taught. Good, because what you were taught is likely what's keeping you from moving forward financially. Today we're covering 5 essential concepts about debt strategy that many traditional advisors either misunderstand or avoid discussing because it doesn't help them sell financial products. We'll identify 3 specific kinds of debt you should stop overpaying, explain the math that proves why this approach works, and give you a clear plan for redirecting the money you're currently misallocating. By the time you finish this series, you'll view borrowed money differently. You'll start seeing it the way experienced investors and business owners see it, not as a weight, but as a strategic resource. And you'll have a concrete action plan you can implement immediately. I use these exact principles in my own life. I don't just talk about them, I live them. My personal portfolio, my operating companies, my investment criteria, all of it is built around understanding the true cost of capital and placing money where it produces the best risk-adjusted return. So pause for a moment. Focus. Take notes if that helps you retain it, because the ideas we're about to cover could represent 6 or even 7 figures of difference in your net worth over a lifetime. Let's begin. The first category of debt you need to stop overpaying is low-interest mortgage debt. I can already hear the objections, but my family always said to pay off the house as quickly as possible. I understand that advice comes from a good place, but it doesn't account for the mathematics of wealth creation. Let's be precise. If you secured a fixed mortgage rate between roughly 2.5% and 4% during the past decade, you are holding some of the least expensive capital you will likely ever access. Sending extra principal payments toward that balance is one of the least productive uses of your money. Want to know what I do personally? I do not pay $1 more than required on low interest obligations. Not one. Here's the reason. The broad U.S. stock market, measured by the S&P 500, has delivered an average annual return of around 10% over very long periods. Now, let's work through the numbers together, because this is the part that matters. If you carry a 3.5% mortgage and you decide to send an extra $500 each month toward principal, you're effectively earning a 3.5% return on that money, because you avoid future interest at that rate. But if you instead invest that same $500 into a diversified low-cost index fund that tracks the broader market, the historical average return is closer to 10%. That's a 6.5% annual gap in your favor. Over 20 years, that gap compounds into a difference of hundreds of thousands of dollars. I've seen this play out repeatedly. I've watched disciplined, hardworking people undermine their own retirement because they were fixated on eliminating a mortgage. They proudly announce they were debt-free, while their neighbors who understood how to use inexpensive leverage were steadily building significant assets. Let me clarify what I'm not suggesting. I'm not telling you to borrow more against your home. I'm not recommending irresponsible behavior. I'm saying that if you already have a low fixed rate mortgage in place, stop making additional principal payments and redirect those dollars into assets with higher expected returns. Here's the practical step. Check your mortgage interest rate today. If it's below 5%, discontinue any extra payments immediately. Take every one of those dollars and open a brokerage account if you don't already have one. Allocate it to a low-cost S&P 500 index fund or a total market fund. Automate the contribution and let compounding do its work over time. Wealthy individuals understand that inexpensive debt is a form of leverage. When you can borrow at 3.5% and invest to earn an average of 10%, you capture the spread. That's one of the mechanisms by which capital grows. That's the approach I use. There's another factor people rarely discuss: liquidity. When you keep cash invested, rather than locking it into home equity, you retain flexibility. If an emergency occurs, job loss, medical issue, market downturn, you have accessible resources. The person who funneled every spare dollar into mortgage principal has equity, but that equity isn't liquid unless they sell the property or take on new debt. Liquidity is critical to financial stability. Remember that. The second category you should stop overpaying is federal student loan debt, specifically federal loans with fixed rates that were originated before rates increased. I'm not referring to private student loans, which are structurally different and often more expensive. I'm talking about federal loans in the 4% to 7% range. What frustrates me is seeing people in their 20s and early 30s direct every extra dollar towards student loans while contributing nothing to retirement accounts. Nothing. They're so focused on becoming debt-free that they skip the years when invested dollars have the most time to compound. The money you invest at age 25 can potentially be worth 20 times as much by traditional retirement age because of decades of compounding. If you delay investing until age 45 because you were prio, writing student loan payoff, that same dollar might only quadruple. Most federal student loans carry rates between 4% and 7%. That's not free, but it's also not a 5-alarm emergency compared to credit card debt. Meanwhile, many employers offer a 401k match, free money, that people ignore while paying down a 5% loan. From a math perspective, that's not optimal. Here's the framework I recommend. Make your required minimum payments on federal student loans on time, every time, to protect your credit. Then prioritize in this order. 1, capture your full employer. 401 match. That's an immediate 50% to 100% return depending on the match formula. 2, establish an emergency fund covering 3 to 6 months of essential expenses in a high-yield savings account. 3, fund tax-advantaged accounts like a Roth IRA if you qualify. Only after those steps should you consider additional payments toward federal student loans, and even then, continued investing is often the stronger long-term move. I've spoken with founders who said they couldn't grow their businesses because they were aggressively repaying student debt. When we reviewed their cash flow, they were sending double or triple payments. Meanwhile, reinvesting in their business could have produced returns of 20%, 30% or more. Every dollar has an opportunity cost. Understanding that cost is what separates effective capital allocators from everyone else. Additionally, federal student loans include borrower protections that other forms of debt do not. Income-driven repayment plans, deferment, forbearance, and in some cases, forgiveness programs. When you accelerate payoff, you may forfeit flexibility and potential benefits. So make the minimums, invest the difference, and build assets. The third category is low-interest auto loans. To be clear, I'm referring to loans at 2%, 3%, or 4%. If your car loan is in T, Hat range, you have inexpensive capital. After adjusting for inflation, your real borrowing cost is minimal. So why rush to eliminate it? The desire to pay off a car loan quickly is usually emotional. People want the psychological comfort of owning the vehicle outright. I understand that feeling, but emotions don't optimize net worth. Math does. My approach is consistent. If I finance anything at a low rate, I select the longest reasonable term and pay the minimum. The cash I could have used for a larger down payment or extra payments instead goes into the market. Consider a concrete example. A $30,000 auto loan at 3.5% for 5 years results in a payment around $545 per month. Some people add $200 extra to pay it off sooner. Over 60 months, that's $12,000 directed toward 3.5% debt. If you invested that $200 monthly at a 10% average return, you'd have approximately $15,500 after 5 years. That's $3,500 more than you saved in interest. And when the loan ends, you still own the growing investment account. The person who prepaid the car only owns a depreciating asset. To be precise, this logic applies only to low-interest auto debt. If you finance the vehicle at 8%, 10%, or 15% due to credit issues, that's expensive debt and should be paid down or refinanced quickly. I'm also not endorsing buying cars you cannot afford. The payment must fit comfortably in your budget. I'm addressing the specific decision of whether to prepay inexpensive debt. Action step, confirm your auto loan rate today. If it's under 5%, pay the minimum. Automate investments with the difference into broad low-cost index funds and leave them alone. Regarding market volatility, over any 20-year historical period, the U.S. market has been positive. Short-term fluctuations are normal. Long-term investing is about patience and time in the market, not timing the market. If your investment horizon is 5 years or more, focus on opportunity cost, not temporary downturns. Strategic use of cheap debt is a common characteristic of how durable wealth is built. That's the distinction between simply getting by and actually accumulating assets. S&P 500, Johnson & Johnson, Procter & Gamble, Coca-Cola. Now that we've covered which debts you should stop overpaying, let's talk specifically about where that freed up cash should go, because this is the part where real, measurable wealth actually gets created. Listen closely. The dollars you were previously misdirecting toward low-rate debt need to be placed into assets that produce returns, cash flow, or both. There's no ambiguity here. Every dollar has a job, and if the job isn't growing your net worth, you're falling behind by default. I use a very specific hierarchy for allocating capital, and it's based entirely on math, risk management, and tax efficiency, not on emotion or old advice that hasn't been updated in decades. Step 1, and this is non-negotiable, is to capture every single dollar of employer matching contributions in your retirement plan. If your company offers a 401k match, for example, 50% on the first 6% of your salary, you contribute at least that 6%. That match is an instant, guaranteed 50% return on your money. There is no legal investment in public markets that reliably gives you 50% the day you put the money in. I don't care if you have student loans, a car payment, or even a mortgage. You take the match first. Anyone who advises you to skip free money so you can pay down a 4% loan faster does not understand basic arithmetic. Step 2 is building your liquidity buffer. I want you to have 3 to 6 months of essential living expenses sitting in a high-yield savings account or money market fund. Right now, many of those accounts pay 4% to 5% annually, which is meaningful. This isn't about maximize NG return. It's about protection and optionality. Life is unpredictable. Medical bills, job transitions, family emergencies, they happen when you least expect them. If you don't have cash reserves, you'll be forced into high interest debt at the worst possible time, and that one event can erase years of progress. Liquidity is the oxygen of your financial plan. You can survive without investment gains for a while. You cannot survive without cash flow when you need it. Step 3 is to fully fund a Roth IRA if your income makes you eligible. For 2025, the contribution limit is $7,000 if you're under 50 and $8,000 if you're 50 or older. The Roth IRA is one of the most powerful tools in the tax code for long-term wealth building. You contribute after tax dollars today. The account grows without annual tax drag, and qualified withdrawals in retirement are completely tax-free. Over 30 to 40 years, the difference between taxable investing and tax-free growth can easily be 6 figures or more, depending on your contribution consistency and market returns. That's money you keep instead of sending to the government, which directly increases your real wealth. Step 4, once you've captured the full employer match and funded your Roth IRA, go back to your 401 and work toward maxing it out. The 2025 employee contribution limit is $23,500. Every dollar you contribute reduces your taxable income for the current year if you're using a traditional 401k, and it grows tax deferred until retirement if your plan offers a Roth 401k option and you expect to be in a higher tax bracket later. Splitting contributions can make sense. The point is to use the tax advantage space you have before moving to taxable brokerage accounts, because the tax savings compound just like investment returns do. Step 5 is where I personally spend a lot of time in capital acquiring assets. Pay me on a regular schedule. I want cash flow, dividends, interest, rental, income. These are streams of money that show up whether the market is having a good week or a bad one. In my own portfolio, I emphasize dividend growth companies and ETFs. I look for businesses with long histories of increasing their dividends through multiple economic cycles. These are companies that have survived recessions, inflation spikes, supply chain disruptions, and still raise payouts to shareholders year after year. That kind of durability matters. I also use broad dividend ETFs for instant diversification. Funds that hold dozens or hundreds of dividend-paying companies reduce single stock risk while still delivering steady income. The dividends get reinvested automatically, buying more shares, which then produce more dividends. That's the compounding loop that builds serious wealth over time. Here's the central principle. Every dollar you waste overpaying cheap debt is a dollar that could be compounding for you instead. It could be buying ownership in productive businesses. It could be generating passive income that eventually covers your living expenses. When you shift your mindset from debt elimination at all costs to asset accumulation with strategic debt management, your entire financial trajectory changes. I've applied this framework for decades. I didn't build wealth by racing to pay off 3% mortgages. I built it by deploying capital where the expected return was higher than the cost of that capital, and by doing it consistently for years. You can do the same starting now. Let me address a common objection. What if the market crashes right after I invest? Short-term volatility is guaranteed. It's part of the process. But if your time horizon is 10, 20, or 30 years, temporary declines are irrelevant to the end result. Historically, the broad market has recovered from every downturn and gone on to new highs. The real risk isn't the crash. The real risk is sitting in cash or overpaying 3% debt while inflation and opportunity cost eat your purchasing power. If you're investing money you don't need for 5+ years, your focus should be on contribution consistency, not on predicting next month's headlines. Automate your investments, ignore the noise, and let time work. Now, a critical clarification before we move on. Everything I've said about not overpaying debt applies only to low-interest, fixed-rate, non-toxic debt, generally under 5%. If you're carrying high-interest consumer debt, the rules invert completely. Credit cards at 18%, 24%, 29% APR, personal loans at 12% plus, buy now, pay later balances that snowball, payday loans. This category is financial quicksand. There is no investment that reliably beats a 24% interest rate. Paying that off is a guaranteed risk-free 24% return. You will not find that anywhere else. I've reviewed the finances of entrepreneurs with great business ideas who were stuck because $20,000 or $40,000 or $40,000 of credit card debt was compounding against them monthly. They were making minimum payments and losing a battle they could not mathematically win. So here's the tactical approach for high interest debt. First, write down every balance with an interest rate above 8%. List the balance, the APR, and the minimum payment. Second, attack the highest APR first, regardless of balance size. This is called the avalanche method, and it minimizes total interest paid. The snowball method of paying smallest balances first might feel good psychologically, but it costs more money. Math doesn't care about feelings. Third, direct every spare dollar toward that highest rate balance while paying minimums on everything else. Cut discretionary spending, sell unused items, add freelance income, whatever it takes to cray. Aid cash flow to destroy the debt. Fourth, once the highest rate balance is gone, take the entire payment you're making and roll it into the next highest APR. Repeat until all toxic debt is eliminated. Fifth, change the behavior that created it. If credit cards are a problem, remove them from your wallet, delete stored card numbers from shopping sites, or switch to debit only for daily spending until your habits are rebuilt. Another nuance, don't confuse being debt-free with being wealthy. They are not the same. I know people with zero debt and zero assets. They rent, have no investments, and no passive income. Technically, they own nothing, but they also own nothing. Conversely, I know investors with millions in low-rate debt tied to real estate or business assets that produce cash flow far exceeding the interest cost. They're using debt as a tool, not as a burden. The goal is not a zero on your liabilities column. The goal is a large growing number in your net worth and cash flow columns. Strategic debt can help you get there faster if you understand the cost of capital and deploy it wisely. To summarize the action plan so far, stop extra payments on mortgage debt under 5%, stop extra payments on federal student loans in the 4%, 7% range, and stop extra payments on auto loans under 5% range, and stop extra payments on auto loans under 5%. Redirect those dollars in this order: employer 401k match, emergency fund, Roth IRA, max 401k, then taxable investments focused on broad market and dividend growth assets. Simultaneously, if you have any debt above 8% APR, reverse the strategy, attack it aggressively, and eliminate it before doing any extra investing beyond the 401k match. That's the full framework. It's not complicated, but it requires discipline and the willingness to ignore outdated advice that doesn't hold up to spreadsheet math. One final point for this section: track your numbers. You can't mana. What you don't measure. Know your exact interest rates, your monthly cash flow, your savings rate, and your investment allocations. Review them quarterly. Automation helps. Set up direct deposits into savings and brokerage accounts the day your paycheck hits, so you never see the money and aren't tempted to spend it. Wealth is built by systems, not by willpower alone. The people who win are the ones who set up the system once and then let it run for decades. That's how you go from paying off the wrong debts to actually owning assets that pay you. Vanguard Total Stock Market ETF, Schwab US Dividend Equity ETF. Let's address the specific debt category that causes the most financial damage and keeps families stuck for years. High interest consumer debt. I'm talking about credit cards, personal loans from online lenders, store financing deals, buy now, pay later balances, and payday loans. This type of borrowed money is not a tool. It's a trap. And if you don't eliminate it with absolute focus, it will compound against you every single month and destroy your ability to build anything long-term. I want to be extremely clear so there's no confusion. Everything I said in the previous sections about not overpaying cheap debt does not apply here. When the interest rate is 18%, 22%, 26%, or higher, the math flips completely. There is no investment, no business, no real estate deal that can reliably and safely outpace a 24% guaranteed cost. Paying off that balance is the equivalent of earning a risk-free 24% return on your money. And you will not find that anywhere else in public markets, not from the best hedge funds, not from private equity, not from venture capital. Guaranteed returns of that magnitude simply do not exist elsewhere, which means eliminating this debt is the highest return move you can make with your dollars right now. I've looked at hundreds of personal balance sheets over the years. I've sat across from entrepreneurs with brilliant product ideas, strong margins, and real customer demand, yet their personal finances were in chaos because of $15,000 or $35,000 or $60,000 in credit card debt. They were sending minimum payments month after month while interest charges added hundreds or thousands of dollars back onto the balance. They couldn't invest in inventory. They couldn't hire help. They couldn't take calculated risks in their business because their cash flow was being drained by interest. They were fighting a battle. The spreadsheet says you cannot win if you only pay minimums. That's why this category gets treated differently than a 3% mortgage or a 5% student loan. The interest rate determines the urgency. Here's the exact process I tell people to follow, step by step, with no shortcuts. First, get a complete inventory, open every account, every app, every statement. Write down each balance that charges more than 8% APR. For each one, record 3 numbers: the current balance, the interest rate, and the required minimum payment. Do not skip this. You cannot solve a problem you haven't measured. Second, rank those debts by interest rate from highest to lowest. Ignore the balance size for now. This is called the avalanche method, and it is mathematically optimal because it reduces the total interest you will pay over time. I know there's a popular alternative called the snowball method where you pay the smallest balance first for psychological wins. That approach can work for people who need momentum, but it costs more money. If you want the fastest, cheapest path out, you attack the highest APR first. Math doesn't care about feelings. Third, pay only the minimum on every debt except the one with the highest rate, toward that top rate balance. You throw every possible extra dollar, cut subscriptions you don't us, e-pause dining out, sell things in your garage, pick up overtime, freelance work, or a temporary side job. I don't care where the money comes from as long as it's legal and ethical. Find the cash and point it at the target. Fourth, when the highest rate balance hits 0, you do not celebrate by reducing your total payment. You take the entire amount you were sending to that first debt, minimum plus all the extra, and you add it to the minimum payment of the next highest rate debt. This creates a rollover or avalanche effect where your payment power gets bigger with each debt you eliminate. Fifth, repeat until every balance above 8% is gone. Once you're done, you need to change the systems that created the problem, or you will be back here in 12 months. If credit cards are the issue, remove them from your wallet and store them in a safe place at home. Delete saved card numbers from shopping sites and your phone's autofill. Switch to a debit card or cash for daily spending until your habits are rebuilt. Set up account alerts so you get a text anytime a purchase over $1 is made. Review your transactions weekly. These are friction points, and friction is what stops impulse behavior. You're not trying to use willpower forever. You're designing an environment where the wrong choice is harder to make. Now, let me address a few edge cases because details matter. Balance transfers can be useful if you qualify for a 0% promotional APR for 12 to 21 months and you have a concrete plan to pay the balance off before the promo ends. Read the terms. There's usually a 3% to 5% transfer fee, and if you don't clear the balance in time, the rate jumps. Don't use a balance transfer as a way to move debt around and feel better. Use it as a tool to reduce interest while you aggressively pay principal. Debt consolidation loans only make sense if the new loan's APR is significantly lower than your average credit card APR, and if you fix the spending behavior that created the debt. Consolidating without changing habits is like bailing water out of a boat without patching the hole. You'll sink again. A quick word on credit scores, because people worry that paying off cards will hurt them. Your score is influenced by payment history, utilization, length of credit history, new credit and credit mix. Paying balances down reduces utilization, which usually helps your score. Closing old cards can shorten your average account age, so in many cases, it's better to pay a card to zero and leave it open, using it once or twice a year for a small purchase that you pay off immediately. Never miss a minimum payment. On-time payments are the single biggest factor in your score protecting your credit while you eliminate toxic debt is important, because strong credit gives you access to cheap capital later when you actually want it for investing or business purposes. Let's talk about mindset, because strategy without psychology doesn't stick. High interest debt often comes from one of three places: genuine emergencies, income that doesn't cover expenses, or spending that isn't aligned with values. If it was an emergency, your first move after paying the debt is building that emergency fund we discussed. CSE, so you don't go back into debt next time. If it's an income problem, your priority is increasing earnings, ask for raises, change jobs, add certifications, or build skills that the market pays for. If it's a spending problem, you need a budget that you actually follow. I don't love the word budget because it sounds restrictive, but all it really means is telling your money where to go before the month starts. Use any system you like: apps, spreadsheets, envelopes. The tool doesn't matter, the consistency does. Track every dollar for 90 days. You'll be shocked where it's leaking. Here's something else that surprises people. Not all debt with a high stated rate is obvious. Some retail store cards offer no interest if paid in 12 months deals. If you miss the deadline by one day, they retroactively charge interest from the purchase date at 29.99%. That's not a deal, that's a trap. Some auto loans from buy here, pay here lots carry rates above 15% and are structured to keep you paying forever. If you're in one of those, refinancing through a credit union or local bank should be on your to-do list immediately, assuming your credit can support it. If it can't, then paying that loan down becomes priority one, because the interest is eating your cash flow alive. Let me give you a concrete example of the difference this makes. Suppose you have $18,000 spread across 3 credit cards at 24%, 21%, and 19%. Minimum payments might total $450 per month, and most of that goes to interest at the start. If you only pay minimums, you could be paying for 15 to 20 years and spend more than $20,000 in interest. If instead you find an extra $600 per month by cutting expenses and adding income, and you attack the 24% card first, then roll payments, you could be debt-free in under 2 years and save well over $15,000 in interest. That $15,000 can then go into investments, which starts compounding for you instead of against you. That's the swing. That's why this is urgent. One more nuance: medical debt and tax debt are special categories. Medical debt often doesn't charge interest if you set up a payment plan directly with the provider, and it's treated differently by credit bureaus than credit card debt. Always call the billing office and ask for itemized bills, financial assistance, and a zero interest plan before putting medical expenses on a card. IRS debt has its own rules and penalties. The interest is usually lower than credit cards, but the consequences of ignoring it are severe. If you owe taxes, set up an installment agreement and treat it as a priority, but still not above 24% credit card debt in terms of rate. The point is to be strategic, not emotional, and to know the exact cost of each obligation. Finally, once you've cleared high interest debt, make a personal policy. Never carry a credit card balance again. Use cards for convenience, points, or fraud protection if you want, but pay the statement balance in full every month by the due date. If you can't trust yourself to do that, don't use cards at all. There's no prize for having a platinum card if it costs you 25% a year. The goal isn't to be debt-free for the sake of a title. The goal is to stop paying guaranteed negative returns so you can start earning positive ones. That's how you break the cycle and move from defense to offense with your money. After that, you go back to the hierarchy employer match, emergency fund, Roth IRA, max 401, then taxable investing, but not before, toxic debt first. Always. Total stock market index fund, municipal bond fund, treasury bill,